Now we have a problem using what we've learned about depreciation, net present value, book values, that operating cash flows. We're just putting it all together here in this example problem. So let's just look at the problem here. So we've got a chance to buy, this says a new washer. You think about it, buying a new machine, some kind of new machine, costs $6,000. We have an old one that we can sell. So we can sell it for $2,000. So I think of it as you're just replacing an older machine with a newer model. You wouldn't keep the older one around, right? And the old one still has some value. You could think about just selling it for scrap metal, or maybe, I don't know, somebody else can still make use of it somehow. They'll pay you for it. So if we decide to buy the new one, we're not going to keep the old one. We're going to sell it for $2,000. All right. The new one will last for 6 years, and it will save $1,500 per year in expenses. So, and that's all. It doesn't generate any new sales or anything like that, but it operates more efficiently. So it'll save us $1,500 per year in expenses. So that's less money we'll have to spend paying for things. All right. The discount rate is 16% and the tax rate is 40%. All right. Now, you might look at this and say, I mean, the way I think about this problem is, first I think about somebody that didn't really know all of the proper analysis here that we've learned from finance and accounting. They could just look at this and say, okay, well, the new one costs $6,000. You can sell the old one for $2,000, so you net $4,000. And I can see how you would look at it that way. But you have to consider that when you sell this old one for $2,000, you're going to have to pay taxes on any amount that you sell it for above the book value. All right. And then the new one will last for 6 years and save $1,500 per year in expenses. So you could say, okay, well, I make $1,500 per year for 6 years in a row. But not exactly, because you're going to have less expenses. You're going to end up with higher taxable income. You're going to have to pay some taxes on that. You don't know that you're going to keep all of that, right, because of the effective taxes. Now, also because of the effective taxes, you're buying a new asset here for $6,000. You're going to have some depreciation expense there that you can take off. So that will reduce the amount of taxes you have to pay. And so those things working together, you have to see how much of this $1,500 you're going to be able to keep after taxes. All right. And then you know the discount rate and the tax rate, so you can put all this stuff together to figure out the net present value. Okay. So the question is, if the firm uses straight line depreciation, what's the net present value? All right, so if we're going to use straight line depreciation over a 6-year period, well, then we're going to be depreciating that $6,000 over 6 years, so $1,000 a year. It also says assume the old washer is fully depreciated, which is information you need to know. That tells you that the book value on the old washer is 0. Right? You've depreciated the entire value of that old washer. It has a book value of 0. All right, so yeah, we're going to look at this. We buy the old one for $6,000. As I said, we're going to sell the old one for $2,000, but we have to pay taxes on that sale. We have $1,500 a year, but we've got to look at depreciation and taxes to find out how much of that we're going to get to keep. Right? Calculate the operating cash flow from that. Okay, so we're going to start here by looking at, well, if we buy the new machine, we're going to immediately sell the old one. Let's see how much of that we get to keep. So the taxable gain is going to be the entire $2,000 because the book value is 0. Right, so we're going to have to pay 40% of that in taxes. That's $800. So what we'll make from selling the old one is $1,200. Right. Now notice this reduces the amount of initial investment required because we wouldn't buy the new one without getting rid of the old one. Right, so if we decide to do this project, then at the very beginning we'll spend $6,000, but we'll get $1,200 back from taxable, after tax gain from selling the old one. So what it really costs us to start this project is $4,800. Okay, so that's our beginning investment there. Okay, and then we have 6 years at $1,500 per year, but this is what we're going to add to our taxable income. So we have to, or this is what we're going to add to our revenues. So we have to figure out how much of that we're going to keep. We're going to have depreciation expense of $1,000 a year. So here's what we'll have. We'll have $1,500 savings from expenses. We can take out depreciation expense out of that, and so we'll add $500 to our taxable income by doing this project. And since our tax rate is 40%, that means we're going to have an additional $200 in taxes we have to pay. And so the net income that we reported will go up by $300 if we do this project. And now, remember, what we care about, though, is the cash flow. And since this depreciation is a non-cash expense, that means that buying the new washer and because of its efficiency, saving us money and expenses, it will add $1,300 in cash to the business if we do the project. That's the operating cash flow. And that will happen every year for 6 years in a row, right? So we've got that for 6 years in a row. We have an initial cost of $4,800. We can find the net present value of that. Here's what our cash flows look like. The net present value is the present value of these future cash flows minus the initial cost. And so the net present value of the project will be, I'm calculating these present values using the annuity factor. You can also use the present value function in Excel or the net present value function in Excel. All of those can get you the present value of these future cash flows. That turns out to be $4,790. The initial cost to start the project is $4,800, so it's a slightly negative number. Minus 9.89 is the net present value, and that would say that doing it this way, this project is not worth doing. It has a negative net present value. All right, now that is assuming straight line depreciation. It turns out that if we depreciate this using the MACRS method, we'll get different numbers, and we'll talk about that in another video. But here's the result doing the straight line depreciation.